In this video, we're going to explain how variable costing differs from absorption costing, which is required by GAAP. We're going to compute unit product costs under each method and then prepare income statements under both methods as well. At issue is the treatment of manufacturing costs. Recall our manufacturing costs are direct materials, direct labor, and manufacturing overhead, both fixed and variable manufacturing overhead. Under absorption costing, we apply all of these costs to the product. That is, we treat them as product costs. They become part of work in process and then finished goods and are only matched with revenues when we sell our product, and then they become part of cost of goods sold. Selling and administrative costs were considered period costs and flowed directly to the income statement. So here's an overview of our absorption costing, which again is required under GAAP and is the method we've looked at so far. Direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead are product costs, while all of our selling and administrative costs, whether they're fixed or variable, are period costs and again flow directly to the income statement. In variable costing, this changes a bit. Our fixed manufacturing overhead flows directly to the income statement and is treated as a period cost. So our only product costs are direct material, direct labor, and variable manufacturing overhead. And we can see they flow into work in process, which become part of finished goods and again are only matched with revenues in the period in which the units are sold. Fixed manufacturing overhead, though, again, under variable costing, is treated as a period cost and flows directly to cost of goods sold. So again, the only difference is our treatment of fixed manufacturing overhead. Under absorption costing, which again is required by GAAP, fixed manufacturing overhead is treated as a product cost, where under variable costing, fixed manufacturing overhead flows directly to the income statement as a period cost. Let's go ahead and take a look at an example. We're going to take a look at unit computations for the Harvey Company. We're going to assume Harvey produces a single product with the following information. They produce 25,000 units per year. The variable manufacturing costs, direct material, labor, and overhead are $10 per unit, and the selling and admin costs are $3 per unit. And then we have fixed manufacturing overhead of $150 and selling and administrative costs that are fixed of $100,000. Let's go ahead and take a look at our unit cost calculations. Under both absorption and variable costing, our variable manufacturing costs, our direct material, labor, and variable manufacturing overhead become part of the per unit costs. However, under absorption costing, we'll also include in our unit cost our fixed manufacturing overhead per unit, which in this case is $6. That's the $150,000 in fixed manufacturing overhead divided by the 25,000 units that Harvey produced during the year, which gives us a unit cost under absorption costing of $16 per unit. Under variable costing, our fixed manufacturing overhead cost per unit is 0 because our fixed manufacturing overhead is treated as a period cost and will flow directly to the income statement. So under variable costing, our per unit cost is only $10 per unit. So again, under absorption costing, all production costs, variable and fixed, are included in our unit cost when we determine our unit price. Under variable costing, only our variable production costs are included as a product cost. Let's go ahead now and prepare income statements using both variable and absorption costing. Let's assume the following additional information for the Harvey Company. During the year, 20,000 units were sold at a price of $30 per unit, and that there's no beginning inventory. If Harvey sells 20,000 units at $30 a piece, sales will be $600,000 for the year, and that's going to be the same for both absorption costing and variable costing, so there's no difference in the amount of sales under the two accounting methods. Our cost of goods sold under the absorption method will be the 20,000 units we sold multiplied by our $16 per unit cost, and again that unit cost includes both fixed and variable manufacturing overhead, which gives us a gross margin of $280,000. Our selling and administrative costs under the absorption method will be $160,000. That's the $100,000 fixed cost plus the $3 per unit variable selling and administrative cost multiplied by the 20,000 units that Harvey sold during the year. This will be the same under variable costing as well. That means our net operating income under absorption costing will be the $280,000 minus the $160,000 selling and admin costs, or $120,000. Under variable costing, let's go ahead and calculate our cost of goods sold. Our cost of goods sold will be $350,000. This will be the 20,000 units times $10 per unit, which was our variable manufacturing cost, which gives us $200,000, plus the $150,000 in fixed manufacturing overhead that flows directly to the income statement. The difference between the two methods, you can see, is $30,000. This is the difference between the units sold and the units we produced. That's 5,000 units multiplied by the $6 fixed cost per unit. The gross margin, again, is simply our sales minus our cost of goods sold. And since our cost of goods sold was higher by $30,000, we'll have a difference in our gross margin of $30,000 as well. And again, the selling and admin expenses are the same under both the absorption and variable costing. Our net operating income is the gross margin of $250,000 minus the $160,000 in selling and admin expenses. The difference in our net operating income. The difference in net operating income is $30,000. Let's go ahead now and take a look at the value of our ending inventory under absorption and variable costing. Recall, we have 5,000 units in ending inventory. We produced 25,000 and sold 20. Under absorption costing, we were valuing these units at $16 per unit, so our ending inventory is $80,000. Under variable costing, we have the same 5,000 units, but now we've assigned a cost of $10 per unit because recall, fixed manufacturing overhead went directly to the income statement. So the difference in our inventory values is $30,000, which is exactly equal to the difference we had in cost of goods sold and net operating income. Let's go ahead and check that indeed our cost of goods sold plus the value assigned to our ending inventory is the same under both methods. Under absorption costing, the value of cost of goods sold was $320,000, and if we add to that the $80,000 in ending inventory, we can see we've allocated $400,000 in manufacturing costs. The same is true under variable costing, except now we've assigned $350,000 to the units we sold this period and have only left $50,000 in our books for the value of our ending inventory.